Yep, I started recording.
Do we have to speak in the mic so it hears us?
Oh, do you guys want to? Well, no, the MacBook picks it up pretty well. But do you
Okay.
guys need us to speak into a microphone? Or are we good? I think we're okay. Really?
Where is it?
It's down here.
Oh. It's red.
Also red.
Oh, now it's green.
Yeah, because I don't know. Try.
It's not bad.
Test.
Okay. All right. Hello, everyone. Today we're going to be going over yield farming and I guess here's the intro slide. So this is the first part of kind of a series called Finance and Crypto. And so we're starting off with yield farming. And we've already scanned the QR code. So we'll go on. And kind of yield farming is defined by three basic elements. First, it's mostly well, kind of passive, but then it's also managed and for a set amount of yield. So yield farmers are not just letting their money or their assets or things like that just sit and do nothing. They're actively managing them and trying to put them where they're going to gain the most return for having that asset. But also a key point is that they have to get a specified return. And that's important because, as we'll learn later, there are some types of things that are not yield farming. Probably the best example of something that is not yield farming is owning a stock. Just because stocks tend to go up over time, we don't know how much a stock is going to go up over time. It's not guaranteed, and therefore it is not yield farming. And other things such as just basically having a credit card that gives you a cash back or whatever, that's also not yield farming. While you are getting, money back for using a credit card, because you're not actively switching credit cards or maximizing your points through credit cards, it can't technically be defined as yield farming. And that's also true for both bonds and for savings, because if you're just putting your money in the savings account or you're putting money in bonds, you're not gaining any additional yield over what you would if you were farming the yields. So kind of an example of why we do yield farming, or what yield farming kind of is generally the equation goes that if we have an asset and we do nothing with it, like what would happen, versus if we have an asset and we farm with it, what would happen? So generally, if we just have the asset cash and we just do nothing with it, either put it under our pillow, which gives us no money, or we put it into the bank, which gives us a very little money, that's not really yield farming, because we're not trying to maximize our APR and find the most efficient way to place our cash. But if we took our money and we gave it to Jeff Bezos for him to start a tech company, and then he told us that he would give us 10% APR for holding his money, that would be yield farming, because we are actively putting it into use. So the general idea is an asset that is used for one purpose is being given out or used in another way in order to get a higher return than would otherwise be used if you were just holding the asset or sitting on the asset. So a couple of quick examples: loaning shares of stock to short sellers, providing liquidity, staking, credit card churning, giving out loans, buying bonds on leverage, and marketing for crypto projects are just a few. Yep.
Is the phrase yield farming used in TradFi?
In,
Describe this activity, like in traditional farming.
it's never been used until crypto came about, but now that it is, it's used almost everywhere. So it's not just for crypto. And in the Jump article, they even talked about traditional finance in their section about providing liquidity. So I guess we're not just going to be looking at crypto specific things, because yield farming can be done with assets such as cash and with traditional bonds and stocks too, because we can provide and eke out just a little bit higher yields by doing some interesting strategies. So another kind of fundamental aspect of yield farming is crop rotation, which is kind of a funny play on words from the idea of farming. So yield farmers are not very loyal. What they like to do is, if a new opportunity comes up, they like to jump around. So they might jump from Pancake Swap to CRO to ETH to, pretty much any other project that they think will give them a larger return for the asset that they're using. So one traditional finance example that's super, super popular and is kind of considered an old form of yield farming is lending to short sellers. And the reason I'm going to show this example is because it's kind of easier to understand, I think, than some of the other more advanced things. So a lot of short sellers, like Wall Street bets, degenerates, like to sell short their shares, but they don't have any shares to short, and therefore they need some. So what happens is people will loan this Wall Street bets guy their shares. Wall Street bets guy will then immediately sell the shares for money, and then he will at a later date buy back the shares on the open market, and he will give the share back to the original holder. Now, this is a perfect example of what we're trying to do in yield farming, because we own an asset, right? We own this stock or this bond or whatever we own, a crypto asset as well, like Ethereum or whatever. So we own this already, but just because we own it, we're not guaranteed that the price will go up, or we're not guaranteed really anything. So what we're attempting to do is we're trying to make additional money off of owning this asset. So this traditional finance example is perfect, because just because we loan our shares to the Wall Street bets guy does not mean that our shares are going to be, they still exist. We still own them. The Wall Street bets guy is just allowed to sell shorts with it as well. And we gain essentially an additional couple of dollars on holding our asset. Now, the asset can still fluctuate in value, as you're hoping it will, because you hope it will go up over time. And so essentially, you're able to still hold your asset just like you would do normally. You have the same risk as before, except now you're generating just a little bit more return for holding that asset, and is therefore the fundamental idea behind what we're trying to achieve in yield farming. So another common, this is a crypto exchange. Well, yeah, exchange Coinbase, no, not Coinbase, crypto.com. And crypto.com has somewhat of a more traditional feeling yield farm than the ones that Brian's going to talk about later, where essentially they call it crypto earn. You take your crypto assets and you just hold them, right? So let's say you have Ethereum, you can still hold your Ethereum, and it's still yours. You still, if Ethereum goes up, you still gain the benefit of the Ethereum going up. If Ethereum goes down, you still lose money on Ethereum going down. But at the same time, you get to put the Ethereum into contracts, and then the market makers at crypto.com will pretty much do whatever they want with it, but they'll guarantee you a return that is set in stone at the day that you stake or lock your assets, because it's not technically staking. And so what they're going to do is they're going to give the money out maybe to individual people who are seeking loans with bad credit. Maybe they're going to give them to hedge funds that are going to use them as leverage for trading, or a very common example is using them to help further the Ethereum 2.0 integration by providing liquidity, or not liquidity, providing, isn't it staked?
But stake.
Yeah, staking it on Ethereum 2.0 so that their network gets better. And another kind of cool example I learned about that is that people will often actually get paid for marketing these yield farming platforms that Brian will talk about. And the value behind this marketing is essentially the holder of the asset will lock their asset into a specific farm. And depending on how much of this asset they lock into the farm, they will receive a large yield. Now, with this large yield, they're essentially incentivized to keep their assets in for a super long period of time. And in exchange for that, these places give them massive amounts of money. But why are these these farms giving a massive amount of money to people just for locking in their assets there? And it's because they get ranked oftentimes based on total value locked. And as Brian will talk about, probably the biggest risk involved in yield farming is that one of these farms goes down or it fails. And by having more total value locked, it is seen as safer. And therefore, the farms are willing to pay a massive amount of money, which isn't really even money, it's just printed, as you see Jerome Powell doing. So these farms print a bunch of money for their early holders, which allows their early holders to, buy into their project, but then also allows them to get higher ranked, attract more people. And it's really great for the people who are in early, but it causes hyperinflation and can be bad for the market for that particular asset going forward. But that is a risk of joining these things, and is why marketing can be a great way of yield farming.
Question.
Yep.
So how do they print Ethereum? Are they printing Ethereum?
No, it would be kind of their own asset that they come up with for their own means. So like, I don't know, there's like Uniswap, don't they have like,
That's not a good example. Let's say Curve. Curve has
Yeah.
its own token, and it gives it to it. Basically, prints more Curve and gives it to liquidity providers, and as a thanks for providing liquidity.
so they're not printing Ethereum or Bitcoin, they're printing their own asset, like crypto.com also does as well. So that's it for me. Here you go, Brian.
Do they do anything other than print their own currency? Because that sounds like a Ponzi scheme if they get it.
Well, Curve in specific is very complicated. I'm not even gonna try to explain like their whole tokenomics. But yeah, I mean the tokens that you get as a reward, you can just sell on the open market and just make your profit, or you can hold on to it if you think the value is gonna go up. But it's basically just like I don't know. It's like kind of is free money, I guess, but not really. I don't know.
Yeah, I mean, it's free money, but those minting mechanism is sensible, like it's only printed if you do specific work. So it's not like arbitrary, and sometimes they can also be used to vote.
Oh yeah, as governance tokens, yeah, yeah. And curve in specific, you can stake your curve and get V curve, and then you can use that to vote on like which liquidity pools get more rewards. So it's kind of there's like a whole like economy there in curve. People trying to get as much curve token as they can to boost the rewards for their stable coins pool. And it's a whole thing. It's called the curve wars if you want to look into that. Abdullahi, did you have a question?
Yeah, is it just yield farming pretty much
No. Wyatt says no.
Well, wait, you said bond trading?
Yeah, like fixed income traders, like they trade rates, and so like, for example, spirit traders, trading interest rates.
Yeah, you're right. That is a sophisticated yield farm, but not all yield farming is like bond trading. So bond trading is yield farming, but it's not an inverse.
All right, interesting. All right, so moving on, we're going to talk about like the different types of yield farming and more specifically how they work. So first we have lending. This is one of the biggest forms of yield farming. For example, one of the money markets, Aave, has like one of the largest total value locked in all of DeFi. And so basically how lending works is that users can borrow assets by putting up collateral. It's pretty much a basic loan. It's just collateralized. And so they pay back interest on their loan, like a normal loan. And then people that supply the asset, the lenders, they get the interest. So it's pretty simple. And so in crypto, obviously the prices are volatile. So the collateral that they put up has to be able to be liquidated. And there's also often liquidation fees if the price goes too low, just to make sure that the lenders aren't exposed to too much risk. And so you can see I put some examples. There are money markets such as Aave, Compound, Anchor, Sushi Kashi, which is just another name for like sushi's money market. Banker Joe, which is Trader Joe's lending platform. And then also we have stable coins. So the Maker protocol and Abracadabra money, they both use a system using collateralized debt positions where users can put up collateral in exchange for borrowing stable coins. And so that's usually how stable coins work. Any questions? Can anybody name any other lending platforms, just out of curiosity?
Crypto.com.
What about in DeFi? Decentralized. I don't think so, because Curve is more of a AMM. But yeah, so the risk in lending is most usually a protocol failure. Like if a protocol fails to liquidate an asset in time, then the lenders can get burnt by not getting the amount that they're owed. Or a hack, that's also considered protocol failure. If there's a exploit and people's assets get stolen, that's a big risk. So the next type is called staking. And so there's two types of staking. The first that we'll go into is the more traditional form of staking, which is validating, where you put up a certain amount of assets in order to get the privilege of possibly being selected to validate some blocks. And so in exchange for you putting up your assets and validating and keeping the network secure, you earn block rewards and transaction fees. And so this type of system, proof of stake system, will be implemented in Ethereum 2.0, which should be coming soon shortly. And so the risk with validating and staking is slashing. If you are an unreliable validator, you can get your assets that you staked slashed or pretty much just taken away. And that's a kind of incentive, like an incentive to be a good validator. So the next type we have is staking protocol tokens, like I was talking about earlier, where you can stake curve tokens. It's another way of just saying locking them up, either for like no specific set of time, or there can be like terms where it's locked up for a specific amount of time. But in return, you get a staked token, such as V curve. And some other examples I put up on there are XSushi, S-Spell, or N-Ice. And so usually these tokens represent earned protocol revenue. And so basically if a protocol earns revenue through like trading fees, or they take a cut on interest if they're a lending platform or anything like that, any way that they generate revenue, they can do token buybacks where they buy their native token, and that the exchange rate between the staked token and the native token, the staked one will increase proportionally. And so that's how that works. And so the risk in this would be project risk, because the rate of the staked token is pretty much dependent on the native token. So if the native token kind of crashes because the project isn't doing as well, investors aren't as confident in the project, then the stake token will go down in value as well. Yes.
You know, if the Uniswap for Uniswap actually entitle you to own a portion of the
I'm pretty sure Uniswap doesn't do that with its token. I'm pretty sure it's just used for governance. Yeah, there's not, yeah, I was kind of looking into that. I don't think they do anything like that. Yeah, can, oh yeah.
I have a question. So lending is like allowing the project to use the tokens versus staking is like locking in. So how
Yeah.
are they different?
Yeah, so lending is actually, the protocol acts as a platform, like mediating between people that want to supply assets and people that want to borrow assets. So the people on the other side, when you're lending, are actual like users that are borrowing. The protocol isn't the one necessarily using the assets. Whereas in staking, the protocol isn't really using your assets. It's just allowing you to lock in your token for whatever incentive that they have for you locking in your token. Usually that would be to stop you from selling it, to kind of help the project gain like credibility. Does that sound pretty accurate? Yeah.
I think there's also another, usually what's being staked is liquidity token, LP token. And so what that means is you will provide like a liquidity between their token and ETH coin. And this is really important for the valuation of their token, because that means you are sort of backing the value of their token. And so when you provide liquidity to an end like Uniswap, they will give you a liquidity provided token that you could use to unlock that liquidity they provide. So you take that LP token, and then you stake it. That means you are sort of guaranteeing that you will provide liquidity for at least a good duration of time to reward for that. So yeah, LP token is like
Yeah, that's a really good point. Yeah, liquidity is very important. So yeah, staking liquidity. That is also, will be seen in Olympus, where Olympus like created this idea of protocol owned liquidity, and they rewarded greatly for that. So going into what Quan was pretty much talking about, This is liquidity mining, and so liquidity mining is providing liquidity to automated market makers in exchange for trading fees and rewards. And so liquidity providers, they earn trading fees. And then in addition to that, many decentralized exchanges reward liquidity providers with the DEX's native token. For example, Curve gives out Curve token, PancakeSwap gives out Cake token, SushiSwap gives out Sushi token, right? Yeah. And Trader Joe gives out Joe token. And so the risks of liquidity mining, there's a bunch. So there's impermanent loss, which I talked about in the DEX and AMM presentation, where your assets in the liquidity pool kind of lose value compared to if you just held onto those assets. And then there's also project risk, such as like a hack or something like that, like there is in pretty much all DeFi projects. And then also like, I meant that's in protocol failure, but project risk is basically if your project that you're holding the native token for, like let's say I was farming in PancakeSwap and I have a lot of Cake token because I was providing liquidity on PancakeSwap, and I have a bunch of Cake token, and then PancakeSwap, people kind of lose faith in it. People don't like it anymore. They sell Cake token. I'm left with Cake token that's like way less valuable. So that would be project risk. Any questions about liquidity mining? Yeah.
Isn't project risk just some permanent loss that's permanent?
Wait, are you just asking if project risk is like a permanent loss or? Yeah, usually if a project dies, that's your loss there is pretty permanent if you didn't get out in time. Because
it's the same thing as a permanent loss, because you're like getting your liquidity transferred all into this token.
oh no, so your liquidity that you provided and the token that you receive is they're separate because the native token is just like an added on like incentive. So in addition to having all those assets inside the liquidity pool, your LP token, in addition to that, you receive some native tokens that you can convert into whatever you want.
Can you give like an example?
Yeah, so let's say if you look at the picture, there's a Cake and BNB. I don't know if that's a good example because it uses the Cake token, but let's say the BUSD and BNB pool, let's say I provided a bunch of BUSD and BNB. I would earn a 14% APR on that. And I think most of that would come in the form of Cake. And so basically I just earn Cake in exchange for providing those two assets. And then those are just completely separate. I just claim those tokens and I can still have like liquidity just sitting there. It's really just like getting free money just printed out into you. Does that make sense? Okay, cool. Any other questions? All right. So next thing that I was mentioning with Olympus is rebasing. So this is a whole topic that's kind of hard to wrap your head around at first. It's a whole big thing if you have never heard of Olympus. So to start, rebasing, what that means is that rebasing tokens are tokens where your token balance changes. So the protocol changes the balance of your tokens. So like, for example, there's a stable coin called Ampleforth. Yeah. That like changes your balance based on the value of the token to try to keep the value of your balance stable. It's kind of interesting. Whereas like in, let's say Bitcoin, for example, your balance just stays whatever it is. The value can fluctuate and it just is what it is. And so projects took advantage of this interesting mechanism and offered it created a system where they offer very high yield rebases. And for this project that I'm referring to is Olympus DAO. And then there are some forks that came after it that helped popularize the whole thing. It kind of became a fad in DeFi. And so basically how this works is users can buy bonds by providing like an asset to the treasury, such as like Ethereum or a liquidity provider token. And then in return, they'll receive some tokens, some of the native tokens at a discount. And then users can also stake their native tokens of the project. And then when you stake it, you'll earn more tokens at the rate of the very high APY. And so basically this whole system, the effect of it is that as people stake, that means people aren't selling as much. So if you keep your token staked and they keep rebasing and you get more and more tokens, on paper, you're making lots of money, but eventually the risk of this is that inflation will be very great once people start selling. If there's like a bank run, basically, where people just kind of lose faith all at once and try to cash out, the price will drop a lot faster than it increased, because they're just basically just printing more tokens. So yeah, I do not recommend getting in these anymore because the fad's over and you'll just get burnt. People that did take part in these did have some success if they sold early enough, like I did in Wonderland. So yeah, yes.
How do you convince anybody to get into this? Because basically it's just rewarding the people who sell first, right? Because like as time goes on, more and more tokens get minted. And then as soon as people start selling, the people who got in first are the ones who pull basically more money from the people who got in last. It's just like a direct transfer of value from the people who got in last to the people who got in first.
Yeah, pretty much. It's just marketing. Be like, yo, I don't know, just attract them with the high APY. And then just create a culture of staking and never selling, because in the picture, the where it says 3,3, that was like part of the I don't know what you call it, part of the culture within the Olympus. What's that? Yeah. So they had this like game theory thing that they like heavily relied on, where it's basically like if no one sells, then we all benefit pretty much, right? Because if no one sells, the price doesn't go down. So that was represented by 3,3. So yeah, people would put like 3,3 in their Twitter names and stuff like that, showing that they're like part of the community. It's like I don't know, big bubble echo chamber kind of thing. Yeah.
Yeah, I mean, there's a common place that like this, you could very well call this out as a company, which but it also brings to an interesting sort of insight into like why use money in the first place. And so what this is sort of like an incentive for people to get in, so that now that people get in and they're open to access more, can be used in the future to facilitate it. So it's a way to bootstrap the adoption of the currency. Now the question now is, are people going to continue using it after this initial bootstrap period, or is everyone going to use rate all at once? Well, we can see now that people do use rate, but in the sort of the few months that it was sort of building scheme, like it wasn't currency to facilitate transactions. So yeah, I mean, like overall, I think what they did was sort of like a experiment on whether or not it's possible to have a long-term currency that's bootstrapped from nothing. But so far, the experiment is failed. Right? I think most people who are in this project is just gonna get-
Yeah, can you go from US dollars directly into any of these currencies? Or do you have to go through Ethereum first?
you need to go to, well, it depends on if there's a market that allows you to exchange this. So if someone will basically take your dollar.
Right.
And I don't think there's a easy way to do that.
I mean, you could probably just use USDC and exchange. Like decentralized exchanges can like automatically route your trade through different pools. So it can go from USDC to ETH to Ohm, for example, without you having to convert to ETH manually. So yeah, and so what's that?
Sorry, I don't think any like centralized exchanges offer.
Nah, probably not. But what was I gonna say? Oh yeah, so the context that I kind of ignored or I kind of left out was that, so for example, Olympus, the goal was to create a what's it called, reserve currency, a decentralized backed reserve currency. And so the whole bonding mechanism where you receive the tokens at a discount was to build a treasury, and then that treasury would back the tokens. So it's a pretty interesting experiment. Any more questions about it? Yeah, maybe we can have a whole like presentation discussion about it, but I don't know if it's relevant anymore since it was a fad a little bit ago. And so back to the interest thing that Wyatt was talking about. So many exchanges, like Wyatt said, like crypto.com, they offer earn services that allow you to earn interest on your crypto just by holding them and kind of keep them on their platform. For example, there's Gemini Earn, you can stake on Kraken, stake on Coinbase. And so most of the yield that doesn't come from like actual like technical staking, like real staking, the yield that comes from like, let's say staking your Bitcoin, like obviously Bitcoin is in proof of stake. How are you going to make money from staking Bitcoin? That yield is earned by lending assets to institutional funds and market makers, you typically through a giant company called Genesis Trading, which is a prime brokerage. And so like Wyatt was saying earlier, when you like keep money in the bank, you earn like super low % interest rate, while the bank lends it out and they earn a much greater interest rate. That like in DeFi, you're kind of skipping the middleman. Just a tiny bit. There still is a middleman, which is a protocol, but you're earning much greater interest because there's no bank in between. It's kind of simulated here. Obviously, there's companies in between, but still, you're getting a much greater interest rate. Yes, Wyatt?
You're also earning a much larger interest rate because of the risk of the people you're loaning to.
Okay.
The risk of the protocol going down.
Yeah, that's true. Yeah. So do you know like where the increased risk, like in this particular instance, like lending to institutional funds and market makers?
Well, institutional funds and market makers are notoriously risky, but they're also able to pay super high rates, right? A market maker isn't going to go to the bank and get the same, loan amount that a home buyer would, right? And so because of that, these lending companies are able to charge much higher interest rates than your bank is, and therefore pass on much higher interest rates to you.
That's right. Yeah, that's pretty much how like prime brokerages work. They strike deals with like funds and just kind of like lend them money in exchange for a decently high interest rate. And so the main risk, besides like all the risks that come with keeping your coins on an exchange, The main risk here is insolvency. Like if Genesis can't come up with the money because their funds that they made deals with can't come up with the money, then you're kind of burnt because you don't get insurance on that unless somehow you did insure, but most people can't or won't because it's not an FDIC insured activity. So any more questions about that? Yeah. Yeah, that's a good idea. All right, so what numbers should we look at, Abdullahi?
Basically, it's like the amount of borrowing that they process the application.
It says 40% here for the 20. Oh, there we go. So all of 2021, they went up like almost 600%.
So it's showing that there's like a lot of proof for that.
Yeah, wow. So yeah, this is where the yield's coming from. Lots of lending.
Are they publicly traded?
Yeah. I think so. But if you guys have ever heard of, what's that?
I was asking if you were publicly traded.
Okay. If you guys have ever heard of Barry Silbert, he owns the conglomerate that owns Genesis Trading. So if you're wondering why Barry Silbert's so powerful, that's part of the reason why. So next we have yield aggregators. So basically these are products within DeFi that specialize in kind of helping you yield farm. They help by automatically compounding and finding like the best ways to like optimize your yield. So for example, we have like Yearn Finance. They have these things called vaults that have their own like strategies that kind of farm in a specific way. So like the picture that I have in here, it's called the Curve Staked ETH vault. And so the strategy says that they supply staked ETH curve to Convex to earn curve and convex and any other available tokens. And then earned tokens are harvested, sold for more staked ETH curve, which is deposited back into the strategy. So basically it's just like trying to compound all the earned assets that you like put in. And then there's also things like Snowball Network and Beefy Finance. They it's like on their website, they kind of pull yields from all sorts of sources, and then they kind of show you where to get the best yield, and you can like deposit through them. And then as like lots of people deposit money through the protocol, they can combine the assets and perform a strategy with like a much larger sum of assets, which kind of socializes the gas fees. Because if you're constantly claiming rewards for that you earn from yield farming, you're gonna spend a lot in gas. So if you can kind of maximize the amount that you're getting per transaction, then that would be optimal. And that is it The slides will be posted on Discord, so you can like take a look at all the examples that I linked in here. Lots of projects that you can look at, and then there's also like two good reads in the references. Any questions? Yes.
Any personal development projects that you
Private, like that I've like used.
that you
Yeah, so for yield aggregators, I've used Snowball Network. Like they're a good place to look at. Like try to find the best yields for things on in the Avalanche ecosystem. You can find like some good yields on stable coins, as you can see in the picture that I put up there. So yeah, I like Snowball because it's on Avalanche. Avalanche has low transaction fees, and then Snowball automatically compounds any rewards that need to be claimed. So that's very nice. And interest, I use actually all three of the examples that I put. My favorite is Gemini Earn. I put a picture of my favorite thing, which is 8% on its stable coin. So it's basically like a super duper high yield savings account because you're just holding USD because like Gemini USD is always backed. And then there's no fees between buying and like converting between USD and Gemini USD. So it's basically just almost risk-free 8% yield on USD. And then I've used Wonderland. I did stake in that. And then when I like realized how like literally like Ponzi these things are, like I kind of like looked into how exactly it worked. I was like, wow, this is literally a Ponzi scheme. So I pulled out and it was good timing. Yeah.
Is Oldville an example of rebasing?
What's that?
The old H.
Oh, HODL.
Yeah.
I mean, yeah, like the 3-3 thing is basically just like HODL except stake. I don't know, it's the same idea, but like HODL is just more of like if you hold Bitcoin forever, you'll be good because Bitcoin will go up in a long time. Oh, that's what you're talking about. The HODL coin. I can't remember. That sounds familiar though. It could be a Olympus fork. I'm not sure though. Anyone else have like experiences with like Olympus forks or Olympus? Well, you broke even? I thought you like made some. Oh, okay. Okay. And then in liquidity, I don't think I've ever provided liquidity just because of impermanent loss. I have staked Spell to try to get some revenue from people using the Abracadabra protocol. Hasn't really worked out because the Spell price has gone down like 70% or something like that since I bought in. So there's that. And then lending, I've used Banker Joe. As you guys could probably tell, Avalanche is where I've done most of my DeFi activity because of super low fees. Yeah, that's pretty much it. Yeah, Banker Joe. Yes.
How quickly can the blockchain execute a margin call if it becomes necessary? Like, does it happen instantly? Like, would you ever have instances where the price is moving too fast for it to fully recover your principal?
Wyatt seems to want to answer that.
Yeah, there's a great story of there's a Mexican farmer who he had like $900,000 in some like he was selling like my earlier example, you're selling a crypto asset, I forget which one, to someone so that they could short it. And there was a mistake in one of the numbers that they pulled from another site. And it triggered a margin call within like seconds, and he lost all his money instantly. So, yeah, very fast, and especially if they use third-party sites for their data, you're just screwed.
Yeah, so I think it depends on one, the chain, what their finality time is. Like Avalanche has like super quick finality, whereas Ethereum has like what, like 15 seconds or something like that in between blocks. So should be very quick, as all like EVM based chains should be. And then it also depends on the Oracle, because basically oracles are like protocols that can kind of pull data from outside the blockchain. So if the Oracle has problems or happens to be slow, then that can kind of cause issues.
So I believe Appalachian will more details on this, but from what I understand is that because of the Oracle code, and because it takes a while to confirm the transaction, like options isn't as liquid or traded on the blockchain as it was. But that's precisely why Solana is so promising, because it's quick like execution time. There are actually new sort of protocols that they develop that automatically scans for margin call and triggers and things like that. It also like follow some sort of algorithm like that is deterministic. And now they're trying to basically find the correct definitive algorithm to execute the operation. But basically the constraint on how quick they can vote for the transaction. That's a big open question. Isn't that like pretty much
Oh yeah. I mean, that's how like Maker works as well, where people are incentivized to liquidate, basically like margin call, like assets that are getting to the point where they need to be liquidated. Any other questions?
I forgot the most recent one where you're shooting the seven systems. The seven siblings. It was a lot of ether that could have basically done Ethereum to like.
Oh, are you talking about the vaults and Maker that were, oh yeah. I mean, I don't think those would have like really affected the market that much, because Maker uses like a Dutch auction system or something like that, where people can or what was it? I don't know, something to do with like auction and stuff like that, but I don't think they would have like touched the market unless for whatever reason someone wants to just completely dump them on the open market, but I don't know. Yeah.
Would the prime broker ever have to cut their return rate if they can't lend out enough or at a high enough rate to make enough to get that return?
Yeah, if they can't, I mean, they're the ones that kind of like keep the rate high because it's good for them. But if their clients, the people that they're lending to, don't want to pay that high, then I guess supply and demand will bring the interest rate down.
Because
But-
it's a stable coin, right? So they have to have USD to back every single new coin they issue, right?
You are talking about two different things. So basically the prime broker is someone that deals with hedge funds, for example. Hedge fund is like, I want to borrow some money, and the prime broker is like, okay, but you have to pay an insanely high return on that.
Right, so like when the prime broker has to like give you your return to like stake
Mhm.
them, right?
So like, let's say if I was like using like Gemini Earn, for example, and I give Gemini like some money.
So then when they give you your like 10% at the end of the year, do they have to then like liquidate some of the money that they've made, convert it into US dollars to like back new tokens that they're gonna issue you?
Yeah, I guess so. If Gemini is returning with yeah, if the return is in a certain asset, then they have to uh buy or mint that asset accordingly. So yeah, Gemini would receive dollars from the prime broker, I guess, and then they would just convert it to the Gemini dollar. Yeah, what?
So you're also, the Gemini Earn is not the prime broker. They're giving their assets to a prime broker. Prime broker liquidates it and then uses the liquidated, like the currency that they sold it for to give out the limit. So Gemini Earn, like everyone has contracts, right? So Gemini Earn will have a contract with the prime broker will have a contract with someone else. So just because interest rates change intraday doesn't mean that, you know, the contracts are just gonna change because of. There's not real, that risk just doesn't really exist.
So then, is there any regulation with regard to the promises that these stablecoins make with regard to having real physical assets to back them?
Well, yeah, the stable coins themselves are regulated, but remember that pretty much every part of this is being done by a different organization. So like the people who are doing the stable coins and keeping the reserve of USD, they're doing something completely different than the other people involved.
So
Yeah.
then for the interest, are there any that operate in a stablecoin?
Yeah, they all, like, imagine it's like, just have Ethereum, right, and you earn interest on your Ethereum. The Ethereum network doesn't give you that interest. They couldn't care less about what you're doing, so that's why.
Okay, so does Gemini Earn work or like, what's the other? Yeah, this Gemini, is that on a stablecoin?
Yeah, so Gemini Earn, I mean, we could take a look at it. So the stable coin like yield is just like one example. So they offer like yield on a lot of different assets. And so you would like earn that asset based on like the yield. And so they have other stable coins such as or the USD coin. I think DAI as well. Yeah, DAI. Sorry, what was your question again?
I just wanted to make sure that this is like, exchange rate, like market fluctuation risk free way to remain 8%.
Yeah, it is. The APY that you get is variable technically, but it hasn't changed very much. Well, if at all, because when I put in it was 8.05% and it still is 8.05%. So it's not that variable. Yeah.
So I've never really looked into like stablecoin, you prior to this, but it sounded like since they're turning to a prime broker, how is this different from just like this investing in decentralized, non-lender? What's the blockchain?
I mean, there's not that much of a difference. It's just like different avenues of going about it, I guess, because like it's just either the centralized route or the decentralized route.
But like the 8%, for instance, the profit has to come from somewhere, right?
Mhm.
Like, is that money that you're lending being lent to other people on the blockchain, or is it being aggregated and lent to like through conventional means
Are you talking about like on Earn?
on Earn? Yeah.
Earn is not like at all decentralized. Like this is all, this is like all through lending to the prime broker.
Not sure.
They're loaning to people.
Yeah, it's like completely institutional
Yeah,
if you're
just
going
like a
through
bank-
exchange.
A bank that gives you a huge return.
Yeah.
It's not, it could, honestly, we don't even need to talk about this in blockchain, well, it could be anywhere in traditional finance. Even. It's just, they're denominated in crypto assets and that's why. they're
Yep.
huge.
So why doesn't anyone in TradFi achieving API?
Because they are, some people,
Okay.
but those people are traditionally the massive BlackRock size banks, right? And there's, in traditional finance, there's no need to incentivize someone to put their money in a bank. There's so much already in, right? It's only because they need it to be in these currencies that it's so much money.
There's not much efficient. So we have that, and a lot of investors try to see how different ways of being crypto is pretty mature right now. But in the future, as things mature, we'll want to see that mutual. But like another thing, BlackRock or something like they almost trillion dollars.
14.5 trillion under management. So even if they're earning 1%, it's millions of dollars.
So this rate is not, it doesn't reflect any sort of like technological, but rather sort of like they want to incentivize people. So it's rate is nice.
Yeah, when there's more, when everyone buys something, then typically the manufacturers rather, there's also hedging. Like a lot of people have to now sell that asset. What happens, like it starts going down even more, and like there's no way to actually see the price increase because the actual amount, like liquidity in the system is so much that price distribution, like, it's rare to happen. When you get like over one standard deviation. Pricing, right? Because there's a lot of money. And it'll take more money to create like a 3 standard deviation. And so in crypto, like it's so easy to like move the markets that there's not much to do. That's kind of the reason for that.
Doesn't it also have to do with the risk of
When you say risk,
like a lot of people demand higher interest rates due to the clients they take on before, getting their loans through Gemini and whatever. They probably are much riskier clients than the ones in the bank. Yeah.